we haven't hit a clear-cut recession. We've had rolling recessions, certainly housing and autos, manufacturing, and so forth. But we haven't hit the big one, the recession. And in fact, what's happening, to many people's surprise, is inflation is coming down faster than they have expected. A lot of people were of the view, like Larry Summers, and I think he's still there, that we are closer to a 70 style inflation than most people think. We disagree entirely. And I think many people who follow Larry and others are surprised to see inflation coming down so quickly.
Despite over a year of widespread warnings, the impending recession appears to be edging closer to the American economy, even amid the Federal Reserve's significant increases in borrowing costs. Nevertheless, the economy demonstrates resilience as consumers sustain spending and businesses maintain hiring. Notably, inflation has dropped to its lowest point in 2 years, enabling Americans to manage their finances more effectively. Recent government estimates suggest a robust 2.4% annual growth rate for the economy in the April-June quarter, exceeding expectations and driven by substantial business investments in equipment, software, and buildings. This current economic outlook aligns with the growing belief that a sought-after soft landing might be attainable, a scenario where growth slows and inflation recedes without triggering a full-scale recession. Optimistic economists are increasingly hopeful that a recession can be averted, even if the Federal Reserve continues to uphold elevated interest rates for an extended period. Analysts find reassurance in the fact that certain potential threats to the economy have either proven less damaging than feared or have not materialized. For example, the recent resolution of the congressional dispute over the government's borrowing limit had minimal impact on financial markets and the economy. Furthermore, the contained effects of last spring's banking turmoil following the Silicon Valley Bank's collapse suggest limited harm to the overall economy. Looking ahead, Cathie Wood's forthcoming discussion will offer valuable insights into her macroeconomic perspective. Topics such as monetary and fiscal policy, along with key economic indicators, will be covered, providing a comprehensive understanding of the current economic landscape.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
We got a downgrade. Fitch downgraded government debt this week. And some economists are treating that with alarm, and others, including strategists, are treating it with a yawn. And the truth is probably somewhere in between, as is usually the case. It really is a sign that our spending, the government spending, in the last 5-6 years has just been out of control. And my reaction to it is, hopefully this is a warning to the legislature and politicians generally that, the spigot is going to have to stop. And it's interesting, as I look in the GDP accounts at the government line, it's actually shrunk as a share of GDP, and most of the spending is not in the GDP report. GDP is production of goods and services in the U.S. economy. And a lot of the spending has moved off into social programs, which are not part of GDP, like, say, defense would be. So I think that topic is going to gain a lot of currency. Maybe they'll skip through it over the election year and campaign season, as they usually do. But I do think Fitch is warning us that we're going to have to deal with this issue in one way or another. Our point of view would be enact policies that encourage very rapid growth, because we're on the threshold of some technologies, as you know, we talk about them all the time, really turbocharging growth. And the best way to get out of a debt problem is to grow out of it. So that's one thing. The other thing that happened that was kind of interesting from a fiscal policy point of view, especially now that we've entered the election campaign season, was movement on crypto legislation in the House. Now, we don't think it will get out of the House because Maxine Waters is head of the Financial Services Committee and is not pro-crypto. But crypto, or as Art Laffer would say, could you please use a different word like digital assets legislation? We do think that it will become an election year issue. And the fact that it's even stirring in the House at this point in time and becoming a conversation, we think is going to work to the benefit of crypto. And what's very interesting is, whereas we thought we had a bipartisan issue in crypto, the side seemed to part, especially with Elizabeth Warren siding with the banks, interestingly and unbelievably, that we need to be very careful in this realm. We should not trust it. So we thought there was a partisan divide evolving, but we are seeing some Democrats coming back to these bills. There were two that were voted. Well, one has been voted on already, and it got 6 votes from the Democrats. And the next one, that one was on market structure. The next one is on stablecoins, and apparently that will have many more than just 6 votes from the Democrats. So this could become, yet again, a bipartisan issue, which we think it should be. Innovation solves problems, and this crypto legislation would really put in place the layer of the internet that no one contemplated in the early days of the internet, because it simply was a place to exchange information. Nobody thought about commerce or financial services.
Analysts highlight 2 prevailing trends that could potentially prevent an economic downturn. Some experts observe an unfolding scenario often referred to as a rolling recession, wherein specific industries contract, but the overall economy manages to avoid decline. Meanwhile, others suggest the possibility of a recession, where significant job cuts have primarily impacted higher-paying sectors like technology and finance. These industries, populated by financially resilient professionals, are better equipped to endure layoffs, lessening the likelihood of these job cuts dragging down the broader economy. However, persistent threats remain. The Federal Reserve recently raised its primary interest rate to approximately 5.3%, the highest level in 22 years, with the possibility of further increases before year-end. These elevated rates translate to substantial borrowing expenses for both consumers and businesses. Consequently, some economists caution that despite these mitigating factors, a full-fledged recession remains a looming concern.
About this period of time, and while I have always thought it was characterized by booms and busts, and it was, what Art says is those booms and busts happened very quickly, 6-week periods of time before they'd clear up. The booms and busts that have evolved since the Fed took control have been many years in the making, and then when they happen, they are extremely destructive. So just putting in a plug for that. Anyway, on monetary policy this time around, Chairman Powell, in his testimony to Congress, basically used the word restrictive to describe monetary policy, which is a big step, I thought at least. And he wasn't thinking about it in terms of the money supply. And as you know, we've been talking about the money supply falling on a year-over-year basis. And in fact, if you go back into 2021, you'll see that the money supply really hasn't gone anywhere in 2 years. This is extremely unusual and negative year over year, as I've said on all of these calls, since M2 growth turned negative early this year. That we have not seen since the 1930s. And we've also seen a collapse in banks' willingness to lend. They're very worried about the health of the economy, and they're facing even more capital restraints, we've learned in recent days. So monetary policy is restrictive, but Chairman Powell was referring to real rates when he said that. So The Fed funds rate is at roughly 5.5% now. And CPI inflation, that's headline inflation, is 3%. That's 2.5% real rates. And if you look back, you'll see that rate, real rate, 2.5%, was the peak right before 0809. So that's somewhat concerning. But more concerning to me is that the inflation rate is coming down so rapidly now that what if we're at 5.5% on the Fed funds rate and 0 on inflation by the end of this year, which we believe is a real possibility? That would be a 5.5% real rate. And we haven't seen those since the 80s, when the Fed was all about fighting the return of double-digit inflation. That's not where we are right now. So I think that what's going to happen in the next few months, as inflation continues to come down, is that more and more people will be talking about this real rate, which is really starting to mount. And I think it was healthy to hear Chairman Powell refer to monetary policy as restrictive. So half of the solution is understanding the problem. If he thought monetary policy was still too easy, that would be a big problem.
Despite a summer slowdown in the job market, its strength persists, defying projections that elevated interest rates could push the United States toward a recession. In the previous month, U.S. employers added 187,000 jobs, slightly below expectations. However, the unemployment rate decreased to 3.5%, indicating the job market's ongoing resilience. This hiring performance improved upon June's figure of 185,000 jobs, a number that the Labor Department revised down from the initially reported 209,000. Economists had anticipated the creation of 200,000 new jobs in July.
As has been the case for the last, year and a half almost, other measures of employment are contradicting the non-farm payroll. This time it's household employment. Household employment was negative, I think, in May, to the tune of 300,000, but it's coming back, and it was up 268,000. So lots of cross currents. But one thing we are seeing, and I think is really important, is the average work week is going down. So it went down 0.3% in July. And what that tells us is that companies are still hoarding labor. They're afraid to let employees go because they had so much trouble attracting them in the last couple of years, especially in and around COVID. So I do believe that they're going to face severe margin pressures as they hoard labor, and their pricing power diminishes even more. So I believe that the average work week has not been this low since at one point in 2020 during COVID. So that gives you a sense of the labor hoarding. The employers don't want to lay people off. They'll just give them fewer hours to work. Average hourly earnings were up 0.4%. That was a little higher. Again, the Fed's watching that. Others who are very focused and remember the 70s style inflation are focused on wages, because wages went up and pushed through into inflation.
In a scenario known as a rolling recession, different sectors of the economy take turns contracting, with some experiencing declines while others continue to expand. This approach helps the overall economy avoid a complete recession. The housing industry was the initial casualty, entering a tailspin when the Federal Reserve raised interest rates sharply 16 months ago. As a result, mortgage rates almost doubled, leading to a 19% drop in home sales compared to the previous year. Manufacturing followed suit, with factory production down from the previous year, although not as severely as housing. Despite these changes, the impact on everyday Americans hasn't been as stark, especially with the stock market's gains this year. However, significant job losses that began the previous year have been concentrated in higher-paying professions. This deviates from the typical recession pattern, where lower-paying jobs in sectors like restaurants and retail are usually the first to be shed, often in substantial numbers. In most downturns, reduced consumer spending prompts layoffs in hospitality and retail, while decreased home purchases lead to job losses in construction. The decline in sales of high-priced manufactured goods like cars and appliances also contributes to factory job losses. Presently, the situation differs. Restaurants, bars, and hotels continue to hire, serving as major contributors to job gains. Construction companies are also adding workers despite higher borrowing rates that typically discourage building projects. The question remains, will the U.S. economy manage to evade a recession? Share your thoughts in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.